What's up, tax savers? So we're diving more into tax reform today. I want to kind of dive into a little bit more detail on what the mortgage interest deduction and the state and property tax deduction limitation changes are. So first, let's talk state and property taxes. So it used to be whatever you paid in state tax and whatever you paid in property tax for the year was all deductible. Now, there were some certain limitations for high income earners where those phased out, but in general, all of those were deductible. That's now changing to where the limit is $10,000 for both of those combined. So if previously you had a $5,000 tax bill and an $8,000 state income tax when you get to the end of your tax return, that would now drop from a $13,000 deduction to a $10,000 deduction. On the mortgage interest side, what used to be $1 million of mortgage, you could deduct the interest on that, is now $750,000. So how that used to work is if you had a mortgage on an $800,000 home, you would get to deduct all the interest on that. If you had a mortgage on a $1.5 million home, you could only deduct 2/3 of that interest, 1 million divided by 1.5. And so now that drops to $750,000. So it's the same pro rata portion, but just capped at $750,000. Excuse me. The other thing they're doing is eliminating mortgages on second homes and home equity loans as deductible interests. So those are going away. So it would be good to figure out how that's going to affect so if you've got a bigger mortgage and or a home equity line of credit, or a second home that you're paying a mortgage on, then your deduction is probably going to go down. Hope that was helpful. If it was, hit that like button or share it out if you think it might be of value to your followers, or tag someone who could use this. And we'll see you next time.
Is